Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Hi everybody, I'm Graham Witcomb, and joining me today is our esteemed research overlord Nathan Bell. Good to have you, Nate.
Thank you, mate.
We've also got our ever level-headed Nick Cummings.
Oh, thanks. I prefer Nathan's intro.
I had to think of a good one here, but anyway.
I'll take level-headed.
Yeah.
Coincides with the release of the He-Man movie, which I'm sure we've all been waiting for the last 40 years.
Yeah. Right. Well, before we get into it, I need to address briefly the news that some of you might have read about the potential merger between Intelligent Investor and the Team Invest Private Group. We're going to be a bit boring on that topic because nothing's really settled yet, and the discussions are just at the board level, so there's not a lot for us to say. But we can promise that we will let you know if anything eventuates from that, and in the meantime, we'll just stay mum on the issue. So on to the stuff that we can talk about. We've got a few topics today. First, we've got Nath talking us through the sell-off in high-quality stocks and whether there might be an opportunity there. Then we'll talk a bit about diversification. And finally, Nick is going to run us through some geopolitical risks and how you could be thinking about them in your portfolio. So, Nath, let's start with you and the high-quality sell-off. Can you please explain what's going on there? Because it has destroyed my healthcare portfolio.
Just let me say one quick thing on the potential acquisition of the business. We, as the analysts, haven't been involved in this process at all so far. So we literally have nothing to tell anyone. I'm sure there are a lot of people thinking that we have been involved and we know a lot of stuff and we're just not prepared to share it, but it's actually not the case. We haven't been involved whatsoever. With these takeovers, it also takes time. Like you see this with if you've ever had one of your stocks taken over, the initial process is very slow. Even though the offer is binding, we're not privy to the details, but there's still a lot of things that need to be ticked off for the deal to actually complete. So we don't actually have any information for you at all. We don't know what the strategy is from tips. We don't know what they want to do, if anything, with the subscription business or the funds business, whether they want to tie that into their own existing business. And we don't know any of that. We haven't spoken to anyone. But I do know that even if this goes through, it's going to take at least a couple of months, and then there'll be a long handover period, potentially of 6 months or more. That's best case scenario. So in terms of actually any changes to the products, where it could be next year at the earliest, maybe it's later this year, like we just don't know. But we haven't even had a preliminary discussion yet with anybody involved. So we honestly don't know anything. But obviously, as soon as there is going to be any changes or something happens, then we will obviously write something on the website, so you know what's going on. But at the moment, we really don't know anything. So just focus on your portfolio at the moment. It's business as usual for us. We're really just trying to focus on the opportunities in the market at the moment, which is a nice segue to the first topic. And I think even though I'm repeating myself to anyone who listened to the webinar last week or the week before, this is the first time in my career, which at least at Intelligent Investor goes back to 2006, so 20 years now, where we've seen quality stocks trading so cheaply compared to the most expensive stuff. And if I think when I first joined Intelligent Investor, it was the last stage of before the GFC whacked us. So as I used to tell people, I had just enough time to lose money, which was really frustrating because everybody else had all the 6 years before that of some of the greatest returns ever made by value investors. And that's when a lot of value investors that people might know, like the Bruce Berkowitz, who was Morningstar Fund Manager of the Decade. You don't hear much about him anymore, but that was the period when a lot of those guys made their reputation. So I missed all of that.
I invested with good old Bruce and then it didn't do anything after that magic decade.
Well, I think he might have went a bit crazy and moved to the beach and wouldn't let anyone near his stocks.
Yeah, that's all he seemed to talk about for a while. I felt like I invested, and then for the next 5 years, all he talked about was his, holdings AIG in Miami and all of that.
I think he had 80% of the fund in AIG. I felt like he was a bit like, who was that guy back in the 30s and 40s who used to made all the new planes and made movies, and then ended up dying alone with the Mormons.
That sounds like a movie.
It is a Leonardo DiCaprio movie. I can't think what his name is. But anyway, there's also a Simpsons episode where the old man tells the guy to get in his model plane. Anyway, the same character I'm thinking of. But anyway,
Howard Hughes?
Yeah, that's the one. So we're in this. Normally everything goes together, right? Like I remember 2006, 2007. Like everything was expensive, and then everything went down together. And it was a similar thing with the I call it the 2-day bear market from COVID, because it didn't last very long. And again, everything went down and then everything went back up. But this is quite extraordinary in that it's been a broad sell-off that sort of started with SaaSpocalypse, so it just affected the software companies, and then it turned into much more growth and quality. But it hasn't impacted the banks, at all. The banks are still trading at what I think are outrageous valuations. And in the US, the Mag 7 and a few others have sort of come off a little bit, but then rebounded, and now everyone's just piled into semiconductor stocks. So the expensive stuff has sort of stayed the same or got more expensive, and yet the quality stuff has really been hammered by AI fears mainly, and just fears of paying high multiples. And I think there's a lot of stocks where that's been absolutely justified. I think Cochlear was a sitting duck trading at 50 times earnings for so long. So things like that's just come back to normal now. Obviously there was a big profit downgrade, but trading at around 20 times is what you'd expect for that sort of business, not 50. But there's a lot of other business we're buying that are trading at 12 times, and a lot of these businesses have never traded that low before. And yes, their best days of growth might be behind them, but I just can't imagine that there's any portfolio out there that didn't need to change from the price action over the, particularly from January to March.
So do you think that that's mainly the AI fear kind of rippling through all of these stocks, but some are being kind of swept out with the bathwater, or thrown out with the bathwater, or are some of these genuinely being affected and their multiples are being corrected kind of rightly out of it?
I think there's three things going on. I think one, there's just some general multiple compression, as now there's the fear of interest rates going up, and that obviously has a different, like the higher the value or the higher the price to earnings to ratio, the more vulnerable those stocks have been. Then you've got the AI stuff, which has really hammered the software stocks. Interesting thing about the Australian software stocks is they're still very expensive. They still trade on massive valuations when you look at actual proper earnings. I don't want to call them fake earnings, but share compensation and all those sort of things are taken out.
Well-adjusted earnings.
That's right. So they're all still quite expensive. So they still need to grow a lot. And I would say it's. Again, I don't want to harp on WiseTech and Xero, but things have changed there too, right? They've both taken on debt to make these risky acquisitions, and their actual underlying businesses are slightly under threat, either from AI or, in the case of WiseTech, it's lost a customer to a competing product, which is probably the scariest thing ever that could happen to that business, given there's actually not a lot of customers in that industry. So there's that. And then there's also, I think, just some general either cyclical things or just company-specific things. And obviously Cochlear was a real surprise in terms of the earnings downgrade. The price-to-earnings ratio going from 50 to 20 is no surprise, because it's never been a double-digit grower. It's usually been high single digits. It's just been very consistent.
Yeah.
And the growth runway has always been huge. So you're getting 8 or 9% or whatever the number was, but you're going to get it for a long time. So that's why most people are prepared to pay a premium. And, they still are the market leader.
I was stunned at how quickly that ratio did kind of reset. It really took like one result, and then everyone just snapped out of it and, realized that it wasn't this completely impenetrable monopoly.
And that's the lesson, I think, for people, particularly people new to the market, is that just because something's gone on for 10 years or 15 years, if you think about a lot of people in the market today buying the ETFs and buying semiconductor stocks and all this sort of stuff, the last real tough period for markets was the GFC, and a lot of people wouldn't have even been invested then. So all they've seen is this one-way bull market that had a small fall in COVID, but it only lasted a couple of days, and then everything bounced back to records that we're back at now. Other than that, every time there's a little problem, it seems to get swept under the rug with either some government spending or the central banks acting together, which was the case a few years ago when some of the banks and little banks in the US look like they're going to cause problems. But just because something hasn't happened for a long time, it sort of tends to make people think that reality is not going to hit. And what's the old line about up by the escalator, down by the elevator? And it just happens instantly. And I think there's some people that would probably think, oh no, it's all right, I'll stay invested. When I see the bad news, I'll be able to get out in time. And you don't get the time, especially today with the way the algorithms are working. Like, we couldn't even get trades in. If we had our own Cochlear, saw the announcement and said, oh, this is bad, or we need to sell, there's no way physically that we could have got those sales done to avoid the fall. Like, the fall was already done before we would have even had our orders to the brokers. So it's impossible. Like, once the news is out, it's incorporating share prices in seconds, and there was a huge fall. But then there's some of that was cyclical as well. I think everyone thought, there's always going to be steady revenues at Cochlear, and it turned out that actually they're very expensive, and there is some cyclicality because of how expensive it is. And I think that's been the case with the commercial brokers, insurance brokers. They're trading, the Aussie ones are trading around 12 times. And yes, there are some AI fears, but I'd say the bigger impact on the share prices at the moment is the fear of a soft insurance cycle and just not being able to put up premiums. And, so you've got these stocks trading at 12 times, which are about as consistent as business as you're going to get. And, if you're thinking you're going to go through a recession, yes, there might be a little bit of softness through the recession, but people are still got to have their businesses insured. Still got to have everything else insured because you just can't afford not to. You might give it a softness because people aren't buying new cars and things, but these companies will get through that, and they're trading at 12 times earnings on 4% fully franked dividend yields.
Yeah. So do you think that this seems like it was just a big wave that kind of came through and affected lots of stocks together. Is that something that people can avoid, or are you just have to take these big waves with the business? If you're going to be an investor, you have to deal with these moments where suddenly everything is going down at once.
Yeah, I imagine the hardest thing for people at the moment is if they're in stocks that are either have been winning or aren't going down. And it's really hard psychologically to sell those and buy something that just looks like, with the insurance brokers, for example, like maybe the soft insurance market lasts 2 or 3 years. You just don't know when the multiples will come back and the earnings growth will pick up, even though actually it hasn't been any bad earnings yet from Oz brokers. It's really what the market's just thinking is going to happen. It is tough to do, but you've got to do it. Like, I just think I showed a chart, and I've showed this chart for the last year or so of the All Ordinaries Index from 2007 to actually out to 2023. You can take it, and there's next to zero capital gains. All you got was basically a 4.5% dividend yield. So that's that's over a decade of no capital growth. And the thing I'd say about that index is the banks weren't as expensive back then, and their prospects were much better than they are today. Like, this bull market in Australia the last 3.5 years has really just been a bull market in banks. So it's been very different to the US, where the tech stocks have actually grown their earnings, and therefore they've justified a lot of the increase. But that is just not the case.
And even more bizarre, given all of the fears out there are affecting the whole economy, and what could be more tied to the economy than the banks? That seems like a perfect, counterpoint to it, that they can't go up when everything else is going down.
And you've got Macquarie taking market share. You've got the margins under pressure, and that's in a good economy where everything's going perfect. Like, the bad debts couldn't be any lower. Credit growth has been fine. Most people have got a job that want one. Like, it doesn't get any better than this for the banks, and they're just such a massive component of the index now. Like in the old days, you used to get a decent bit of diversification when you bought the index, where you're just not getting that now. So, but I think it's obvious. Statistically, it's obvious where the potential value is, and it's very, very obvious. It has been for a while, years, I'd say, where the value isn't. So if you're not making the change, it's either because psychologically you don't want to make the change, or secondly, a lot of people would make tax arguments for not wanting to sell their shares, but maybe that's gone away since the budget last week.
Yeah, and I think it's a good point about kind of the diversification with the banks because not just the index is concentrated, but so many people will own different banks thinking that they're diversified. They own a little bit of Westpac, a little bit of Commonwealth or whatever, and think, oh yeah, well, I've got these 4 stocks sitting there, but actually they all kind of move in sync, and they're not really any more diversified than if they'd probably just held one of them or 2. So yeah, that touches on the article that we put out this week about naive diversification, where you've really got to consider what the individual stocks in your portfolio are tied to and the risks that they're exposed to, not just thinking I own 20 stocks, therefore I am well diversified here.
I think even in the good times, I think people forget that, because we are usually in markets, we're mostly in good times. Like, bear markets don't happen very often and they don't go for very long. So you tend to think that, just buy the best stocks for the next 10 years or whatever it is. And you actually forget what actually the nature of some of those businesses are sometimes just because of time. A bit like you become accustomed to it, like the Pavlov's dogs. The banks are, ironically, are the place where the big money is hiding at the moment. That to me is like it's laughable. Like the banks are some of the most cyclical businesses you can buy. The one thing that the Australian banks have that perhaps other banks around the world don't have, but certainly some of them would, but is an implicit government guarantee that they'll help them get through any bad periods. And because we haven't had a recession since I was in, I think, year 11 at high school, people just aren't baking in any recession or anything into these bank valuations. But it's not just banks; it's all the big stocks. Even Woolworths is very expensive now for little growth. I think was you cover that one, Graham? Got that one spot on. The Wesfarmers is expensive for what it is. These are all, no one's arguing with the quality of their businesses, but I just think we're going to have a repeat for the index of what we got between 2007 and 2023. Except I think this time it could be worse because the starting valuations are so much higher. The dividend yield of the index is close to 3%, not 4.5%. And the competitive advantages and the growth prospects of those businesses are just far weaker than what they were back then.
Do you think the answer then is to everyone should be holding a bit more cash at this time, or is it that they should just stick to the kind of undervalued stocks that are on our buy list, or how do you actually get around that risk then?
Yeah, it's interesting. The diversification thing I think is really interesting. Like broadly, I actually feel like even as a stock picker, so not as someone who might be 60 or 70 years old going into retirement and having to think about income versus growth and how much do they want in stocks and all those sort of things. And I think one of the things about diversification that isn't often talked about, particularly outside stocks, is the price you're paying for that diversification, because that's ultimately tells you whether diversification is worth having. Are you getting your diversification cheaply? So are you getting that cheaply in bonds? Are you getting that cheaply in corporate credit or, however, or other alternative assets or whatever you happen to diversify into? That to me is never talked about enough. It's just always about stocks or bonds, and that's about as complicated as most chats seem to get. But in terms of just a couple of things, I think this is because of what's going on with AI and because asset markets are just generally so high, I think you want to be a little bit more diversified where you can get it at a good price. So I just don't think this is the time to be having 10, 12, 15% in any one stock when AI is floating about, because I think you've got to be really humble in this environment because we just don't know what we don't know. Like no one knows what AI is going to be able to do in 3, 4, 5 years. But I do know when you're paying 12 times earnings for a stock that you're going to get a lot of that cash flow back before AI becomes a risk. And so I think that's really important to the price you pay. And I think you want to be a bit more diversified if you can. And I think that's what's uniquely interesting about this last 3 or 4 months compared to the last 4 years is you actually on a stock basis, you can actually buy the world's greatest businesses at the biggest discount they've traded at to stocks generally, I think in a decade or, even longer for a lot of these stocks. So you don't actually have to compromise on quality to buy cheap and feel very comfortable about your portfolio.
Yeah. Mm. What do you reckon, Nick? Do you think that we should just be ignoring the macro and focusing on the individual stocks, or is this the time that you should be focusing on the big risks like AI and geopolitics and all that?
Well, I might touch on geopolitics in a second, but I agree with what Nate's saying. I would add this. There's one other thing I'm noticing going on with the sell-off in these high-quality stocks. There's AI, previous valuations, and then company-specific stuff. But one thing we haven't spoken about, and I'm just noticing more and more, is that essentially these stocks have now been underperforming for 6 months to a year, and at the same time, while other parts of the market have been going gangbusters, particularly in the US and particularly that semiconductor and tech space. And you're seeing more and more investors just get FOMO. They're changing their investment philosophies. They're selling out of what they, the high quality businesses they used to own, not because the earnings are bad. In most cases, they're actually really good and in some cases improving. It's just because the stocks aren't going up and this other group of stocks is, and they're just coming in and buying those stocks. Like, for example, overnight, Micron, which is one of the biggest memory companies in the world and for the moment a clear beneficiary from all this AI spending, it was up 21%, not because its earnings were fantastic, because an investment bank released a positive research note on that company, and the company's now worth $1 trillion. Like, the amount of money swashing around here and the amount of money that is chasing these stocks is just incredible. I think the funding source, or increasingly the funding source for that, is previously these high quality stocks, and they're the companies we're finding pretty attractive at this point. With geopolitics, I do think we do have to be cognizant of some of the macro risks. I'm always, love looking at the companies first because no one can predict macro, but I think we do have to be, aware of it, and I think they are increasing.
Are you watching any in particular?
Yeah, the area I'm probably most focused on is this reversal of globalisation. So I guess since the fall of the Berlin Wall, investors have had this real tailwind at their back where rates have been lower, inflation has been lower as we move our supply chains and manufacturing bases to wherever it's cheapest in the world. There hasn't been too much political interference either. So, large mergers between businesses have been allowed to go through. And so we've created this situation where the best product and the best solution and the best companies have done really, really well and have been sort of allowed to thrive. Instead of having 7 or 8 payments companies around the world, we have MasterCard and Visa. Instead of having, I think it was about a dozen memory semiconductor companies around the world, we now have about 3 really in some categories. So we've consolidated all these industries, and that's been a big consequence from globalization. But that's now starting to change, and you can see it changing with tariffs, new national initiatives like increasing defense spending, as well as allies, not getting along, and a lot of that's to do with Trump. But it's not just that. And so I think that tailwind that's been in investors' back for the last 40 years might be ending a little bit, and we might have a period going forward where we do have higher inflation, we do have higher bond yields, and we do see more shocks in the market. And I've been sort of thinking about this through some of the companies we own. I wrote an article about Visa and MasterCard on Monday and some of the new risks. And one risk there is just that Europe and other countries are looking at payments as a national sovereignty issue and looking to roll out their own solutions. And there's a lot of, I guess, momentum behind that now. And I think, whereas countries have tried to do that, say, a decade ago, but it was really, a half-assed attempt. That's now starting to change, and there is momentum behind it. So I think you might see that going forward, whereas instead we have these global champions, potentially we have more of these national champions, and governments really favour some of their own industries and own companies. And that's not to say Visa and MasterCard are terrible investments. So, I still quite like both of them. It's just something we need to think about, and that tailwind at investors back over the last 4 decades, and also that environment where the best product or best solution wins might not be the case going forward. And it's an individual circumstances.
So then should you be thinking about like which is the best country that's going to win? Do you need to kind of increase your geographic diversification or just concentrate on the US or the big ones that have the most influence?
It's a good question, and look, to be upfront, I don't have a good answer to that. Picking who's going to win the AI race on a country level is
we want the answer, damn it.
Yeah, I wish I had it. It's very hard, but I think going back to your point that you need to be diversified across industries, across countries, and you just need to be aware about where your businesses, like how sensitive your businesses are to some of these risks. And I'm not necessarily talking about wars or any of that. Just how much politics is involved in some of these businesses has probably been understated for the last couple of decades, and that's now changing. And so you just need to have a look at each business, based on that as well as the company's fundamentals. So it's try and incorporate both of them.
Yeah. Do you have anything to add to that, Nate?
No, the one thing I'd just say about technology, a lot of the focus, for obvious reasons, is about how AI can dismantle businesses. But just every year that the world moves forward, technology becomes a bigger risk to a lot of businesses anyway, like regardless of AI. If you just look at the banks, like there's just so many ways now that you can do FX trading or just currency swaps to, for cash for holidays or whatever. And so it's, this is for anyone who's suffered through having to get their foreign currency through a bank and get outrageously ripped off. These are just incremental areas where parts of businesses where have previously been very high profit, high margin business are getting eroded. So I think that's just there's a lot of business like BHP, iron ore, it doesn't really suffer from technological risk, but there are a lot of other businesses out there that do. A lot of businesses that have traditionally been thought of as impregnable that are now coming up against competition, not just because technology is improving, but also from political reasons like Nick just discussed. So you just need to have an idea of, again, probability weight the risk, what's the risk of something happening? And if it does happen, what's the consequence to the value of the business? Like, does it completely change the business, or is it just a small change that the business can get on with, and because you're paying a sensible multiple that you can get past that and it doesn't matter? And that's really where we spend all our time as analysts, is thinking about those competitive advantages, because the old framework, as old as it is, about competitive advantages, which seems quaint in the modern world where everything's just focused on AI and massive growth at the moment. That competitive barrier framework is still what's going to decide which companies make money over the next 10 or 20 years, regardless of whether they're AI companies or anything else.
Yeah. So the same old, buy high quality, be diversified, and buy them cheap. It's simple.
Well, it really is. Like, assessing competitive advantages is difficult, and anyone who thinks it's easy is kidding themselves. And I think that's really the lesson from a bunch of reports from a lot of the high-profile growth managers over the last 12 months that have been absolutely smashed, is that competitive advantages, as soon as there's a weakness or the market senses weakness, it's like cochlear. The share price collapses very fast because those are the stocks that are normally trading on high multiples, and you don't have a chance to get out. So you've really got to do your thinking ahead of time and be aware that you're not going to be, even if it is a risk, you're not going to be able to pick when it happens and when the share price reacts. So I really like the idea of, I can't remember who said it, but strong opinions loosely held. I think that really sums up, my personal approach in the current environment and always, really.
Yeah, I think they're pretty wise words. That's probably a good place to wrap up. So Nathan, Nick, thank you both very much, and thank you everyone for listening.